In this lesson, Candlestick Charts, the learning objective is you should know the structure of a candlestick. The candlestick chart is a variation of the bar chart. Compared to a traditional bar chart, many traders consider candlestick charts more visually appealing and easier to interpret. Each candlestick provides a simple, visually appealing picture of price action. Let's look at a candlestick example and what makes up a candlestick. The real body is this part right here. The real body represents the price range between the open and close of that day's trading. When the real body is filled in or red, like these two examples, it means that the close was lower than the open. If the real body is hollow, it means the close was higher than the open, hollow or green. The long thin lines above and below the body represent the high and low range and are called shadows, also referred to as wicks and tails. Most commonly, I think you'll hear it as wicks. The high is marked by the top of the upper shadow and the low by the bottom of the lower shadow. So this part right here and this part right here. Candlesticks reflect price movement like bar charts. When you see a series of candlesticks, you'll see that the bodies and wicks can be long or short. When the body is short, it means that there was not a big difference between the opening and closing price, meaning there's not a lot of volatility. And when the body is extended, it means that there was a larger difference between the opening and closing price. Long green candlesticks show strong buying pressure, and long red candlesticks show strong selling pressure. If the wick is long at the top, it means that during the period being measured, the price rose significantly higher before moving down to its closing price. If the wick is long at the bottom, it means that during the period being measured, the price dropped significantly lower before moving higher to its closing price. This often means that a recovery could happen, but we'll get onto this.